Okay, well, investors are turning less bearish on treasuries and the dollar, according to a survey of Bloomberg users all around the world. Those safety trades appear to be making a comeback amid signs the global economic recovery may not be as quick as hoped for. Suvrat Prakash is interest rate strategist at BNP Paribas, and he joins us now with his outlook on treasuries. And, Suvrat, tell us, in terms of what has happened thus far in treasuries, let's just say within the last few days, what does that tell you about risk appetite?
Well, in the last 2 days, we've seen Treasury prices drop, but that could be the result of some higher than expected inflation data. In the last month, though, referring to that Bloomberg survey, the economy, I guess, just hasn't rebounded as quickly as some had hoped. It's as simple as that. Even though we can still safely say that the worst is behind us, the worst of the recession in terms of house prices in free fall and GDP growth at -5%, even though that might be behind us, the market is constantly reassessing what the future path will look like. And last month, the information just hasn't been as good, I guess. The stimulus package doesn't seem to be working as advertised. And with the labor market also still in decline, investors have maybe been dealt a bit of a reality check.
Right, and in that sense, that is why you see Treasury yields going lower.
That's right. With lower stocks, we tend to see more demand in safer assets such as treasuries, and we also tend to see more demand in the U.S. dollar. So I noticed in the confidence survey there's a big spike upwards in the index for the U.S. dollar.
And where do you see, on the yield curve, where do you see the yields retracing the most?
You know, the front end is going to be, the shorter maturity yields are going to be very pegged to the Fed rate. And the Fed, as they've reiterated many times, they are firmly on hold in the next 3 to 6 months at least. So, as we see, if we see any weaker signs of the economy or deflationary signs, it's going to be reflected more in longer maturity yields. And by the end of the year, we wouldn't be surprised if the 10-year yield makes another revisit towards, say, the 3% level.
And is that going to have any substantial impact on the economy?
It would. Obviously the economy impacts rates, but as for, if rates do go that lower, in an ironic way, it could help the Fed and the government in trying to jumpstart the mortgage market, because a lot of mortgage refi application activity takes place at those lower rates. They were very high in March and April. In the last month or two, mortgage activity has gone down just a little bit because of raising rates, because of increasing rates. We could, it would be, from the standpoint of the mortgage market, it would be a welcome development. Okay,
but you don't see us reaching new levels, though, with yields?
We don't see reaching, the distress levels that we saw at the end of last year.
Right.
That's probably behind us. It would be a stretch to get back to there again unless there's a Japan-style scenario where people are foreseeing a lost decade.
Okay.
Yeah.
Well, Suvrat, tell me, though, in terms of risk appetite, though, when do you see it coming back? It sounds like we're kind of in a holding pattern right now. When do you think it'll come back?
We'll have to see clearer signs. The market tried to raise the prices of a lot of riskier assets in April and May based on forward-looking indicators and surveys. But that hasn't been reflected in the real data yet. So, the market's going to have to see a little more of that before they become convinced and investors start jumping in with both feet into riskier assets.
Okay, Suvrat, thanks so much for joining us on Treasuries and the Economy. That is Suvrat Prakash of BNP Paribas. Thanks so much for being with us.